Hello there. I'm here with Michelle Markey from Warren Buffett Style Investor, and we're doing a collab today. And we're going to be touching upon a couple of subjects. First is, what is your investment style like?
Oh, thank you. Nice to do this collab with you, Guillermo. And my investing style is like Warren Buffett and Charlie Munger because I think they're some of the greatest of all time investors. So I try to study them carefully and try to put into practice some of the lessons that they've shared with the public, going to their shareholder letters for decades, and also just some of the video clips that are out there of them, like when they have the Berkshire Hathaway annual meetings. And from what they've told us about, I try to see if I can do the same thing. So if Warren Buffett is holding on to a lot of cash, waiting for company stocks to go on sale, I'm kind of following in his footsteps and also doing the same thing because he seems to know best. So I don't want to be too aggressively investing when I know that one of the best investors of all time is trying to bide his time and then buy stocks when he thinks that they're available at a good price.
Yeah, that's a smart thing to do when you have so much money coming in as he does. But I find that I'm just a regular buy and hold type of guy. I buy every month, and I try to hold. And obviously, I buy at any price that the index is. I buy the index mostly and some stocks. But when you have $100 billion sitting in your checking account trying to find investments, that yeah, you have to pick your time, and you can afford that because you have a big portfolio. But for most people just starting out, buying every month and holding seems to be a better strategy. I also, my portfolio is bigger than most because I started a long time ago. And so I do cover calls as well and some cash secure puts that seem to help me increase the yield on the portfolio somewhat, and also helps me be a little bit defensive, you know. So that's my style.
No, that's great. And do you, when you do some of those options trades, do you ever worry that some of your good positions are going to be called away if someone wants to buy your stocks now, that when you've sold some covered calls and then other people take away your stocks and then you wish you could hold on to them because you have a low cost basis on them?
Not at all, because what I do is I don't write calls on 100% of the portfolio. For example, now that I think the market is a little bit frothy, I'm doing like 20% of the portfolio, and I would love for the market to go up and reach my strikes on the calls, because the calls are out of the money, and so they have a long way to go. And even if the market rallies tremendously and breaches my strikes, I can always buy back the calls and have a capital loss there, but keep my underlying to prevent triggering that capital gains tax that you very well state, and that is a risk. But if you're managing it and rolling your losers, then it's very little risk, and in fact, it's actually provides some cushion to the downside.
Makes sense. Well, that's cool. And how do you source some of your inspiration from, as far as some investors that you feel like you learn from, or what types of investing styles you like to employ? Like I heard you mention you like to invest in index funds and options. And how did you come to that point in your life throughout your investing journey?
Well, I tell you, I started in this like 30 years ago, and I've been reading Warren Buffett for a long time. And, he says that for the unprofessional investor out there, the best thing that you can do is just invest in the S&P 500 index. I mean, this is not my idea. It's Warren Buffett. And of course, Warren Buffett has a lot of influence from Benjamin Graham and Phil Fisher, and I've also researched Walter Schloss, who used to work with Warren Buffett in the Ben Graham partnership and he was a remarkable investor. Walter Schloss never went to college.
Mm,
He was a value investor. He just bought stocks cheap, and he had a hedge fund, and he managed that. He called it an investment partnership, but he made like 20% returns per year average, and that was very, very impressive for a guy with a secretary and a desk without a computer. I mean, that's amazing.
right.
But I also like Charlie Munger. I mean, Munger, I think, has been a wonderful influence on Buffett. Yeah. So James Cramer and many other investors. I love to read biographies of famous investors because I think they all have something to add and something to teach you.
Right. I agree. I think it's good to expand one's horizons and try to learn from other types of investors. Like, even though people like Howard Marks and Ray Dalio have different investing styles compared to Buffett and Munger, I think they're also great investors to learn from. And I also gained exposure to all kinds of investors that I didn't really study before from reading this book by William Green called Richer, Wiser, Happier. And I feel like that's an amazing book that showed a lot of different kinds of investing styles and rationale behind how some of the better investors operate. So it's always great to study different kinds of investing methods and try to incorporate some of what seems like it's working into our own investing practice, right?
Absolutely, absolutely. And I think it's very important to have the humility to understand that you can learn every day from people. I mean, I've had viewers of my channel that suggest in their comments some things that I hadn't seen before, and it's amazing because we learn every day, and every day we get better at it.
I agree. And I think that's what's so exciting and why I have so much passion toward investing is because it is something where you can be a lifelong student and just keep learning, and it never gets old. Like, just like how 97-year-old Munger and 90-year-old Buffett, or I think he just turned 91, they're still learning all the time. And I think that's just amazing that for even them, like, the investing game itself has never gotten boring, and it's never like they just sat back on their heels and rested on their laurels and said, I made it. Like, now it's time to just hand off the investing portfolios to the next generation. I mean, they're still at it. They haven't relinquished, the joy of investing. And I think that's an amazing thing for anybody who gets into investing. I think it can be a really rewarding and fulfilling journey of just always learning, like you said, and to be able to help other people along the way, hopefully. And that's what I'm also trying to do with my channel, is to share and pay it forward of what I've learned. And hopefully it can help a lot of other people become their own investors too.
Absolutely, absolutely. My channel is about financial education as well. And Warren Buffett has the humility to say that he's still learning. And he originally started with the deep value investing from Benjamin Graham, buying companies that were, fair companies at wonderful prices, as he says. But through Munger and Phil Fisher, he began to see the value of investing in companies that are wonderful companies at fair prices, which is not as cheap as he used to buy, but
Mm-hmm.
still recognizing that they have a lot of growth ahead of them. Because some of these cigar butts that Buffett was buying were companies that were cheap for a reason. They were on the way down, and they had problems. And if you buy a cheap company and it gets even cheaper, you lose money.
Right. Yeah,
So
and I actually wonder about what you think of that trend where it seems like throughout at least the last decade, the average price to earnings of companies has been kind of inching up. And I don't know if you think that's part of a new normal, or if you think that maybe when there's more market corrections, like if interest rates go up next year and in 2023, if there could be markets going back toward the historical mean of price to earnings, or if we have now landed in a permanently higher price to earnings plateau where it's normal for big tech like the fang to stay at like P of 30, if that's the new normal.
Yeah, certainly. I think high growth companies deserve a higher PE, but you're absolutely right. The low interest rate environment that we've had for the last 10 years has really pushed PE ratios higher because the discount rate that earnings of these companies have is a very, very low number. And so as interest rates creep higher, then there's going to be more competition for the investment dollars, and fixed income is going to become an alternative. Right now, it is not. It's all equities because fixed income is not. I mean, there's actually negative real interest rates right now.
Right. Yeah, exactly. It's kind of surprising that I'm surprised that investors would want to have a negative 1% 10-year US bond. I mean, that seems incredible. And I'm guessing the only reason that someone would want to have that is because they're thinking that they're getting even more negative rates of return somewhere else, which I don't know where that could be, if they think it's in stocks, or I'm not sure what that's entirely counterbalancing.
Yeah, sometimes, some institutional investors may have statutory requirements that they need to invest in fixed income. Other times, speculators, I think, might think that fixed income, the small rates is going to get even lower, so they'll have a little capital gain in between, and so they might be trying to time the market there. But I just don't meddle into fixed income anymore. I'm just 100% stocks, and I do a lot of the options to increase the yield and to manage the risk.
Mm-hmm. Makes
Yeah.
sense. Yeah. I mean, I think it's nice to earn a little premium from selling cash secured puts or covered calls. I think it is a helpful strategy when it feels like sometimes like stocks are not on sale enough, at least to me. And so I feel like I don't have that much of a choice except to only buy when I feel like a company is actually on sale, and otherwise just try to stay patient and wait for, what Warren Buffett calls waiting for the fat pitch, as a baseball analogy of, you only swing at the fat pitch. And right now I just feel like I've been being thrown a lot of balls, or, kind of like, not ideal pitches that I kind of think that is, I'm okay with being walked to the next plate if I have to, and not really being too aggressive, because it feels a little bit like if I didn't get into it too much, like some years ago, like even I started feeling like equities were getting expensive in 2017 and 2018, and I'd been reading about that from some other people, and it feels like um, that some of the trends, like some people were even warning back in 1995 or 96 that equities were maybe getting a little expensive back then, only to lead up to the dot-com bust. And I don't know if we're seeing that again, or if, like I mentioned earlier, if things are totally different and it's not as analogous to how the experience might have been like during the dot-com bubble. So I'm kind of curious what your thoughts might be on some of that.
Well, I think that, if you stand on the sidelines waiting for the market to correct to then get in, you might never get in because the stock prices may continue to go up. I mean, since 2018, stock prices went up. They've almost doubled. In 2019, it went up 31%, and 2020, even with the pandemic, the S&P went up 18%, and year to date, it's up north of 20%. Who knows what the last couple of weeks of December are going to look like, but it looks like it's going to be a 20-something return for the year. Obviously, there's got to be a point where there's going to be reversion to the mean, and the S&P has averaged about 10% per year with dividends included for the last 55 years. So, I mean, 20% return every year, it's unlikely to continue, but it could very well, be another 2022 could be another 20-30% return year, and then the year after is the correction. So if you're sitting in the sidelines, you might have to wait a long time, or I mean,
Mm-hmm.
I tell my viewers that the best thing to do is to invest a little bit of money every month. If they have a 401k plan, that's the best because, that's, tax advantage for the investment and for the growth. So I don't know. You haven't invested at all during this
Oh,
year?
no, I have invested a little bit, but I'm trying to hold on to what Warren Buffett says, when it's raining gold, you want to go out with a wash tub, not a thimble. So even though I've invested a little bit this year, it's not 100%. Like I would prefer if I could be 100% invested, but I don't know when the bubble that it feels like to me is going to burst. So I'm trying to not be too invested because I don't think that I would confidently be able to get out when it feels like things are falling apart. Since you can never really time the top or time the bottom, I'm only trying to make investments and things where they've met my criteria of either margin of safety and other types of valuation measures that it seems like a stock is actually on sale. So with a lot of things, I don't feel like, I could choose to pay full retail price, or I could wait for those things to be discounted later, maybe. So I'm opting for a little bit more of a conservative approach where it's harder for me to live with having bought at what feels like full retail price than feeling like my cash is burning up in flames to inflation.
So how much of your portfolio are you keeping in cash for
Like I think I'm probably around 40% in cash
40% cash and 60% stocks, or what?
invested. Yeah.
Wow, that's a very, very large portion of cash. I have a lot less. I have like 5 or 10% cash, uh, but um, but uh, but most of it is invested. And I think, the market historically goes up. If it
Hmm.
goes down for a moment, it's just the nature of the market. It goes up and down on the short term, but over the long term, with the growth of the economy, the earnings should continue to grow as a group. So that's why I like investing in the index, because I get so much diversification that I avoid individual stock risk, and I get to participate in the growth.
Hmm.
So
Yeah, and I think that's fine, and I think it's maybe I have some hubris where I'm trying to be better. I want to do better than average if possible, and I mean, with kind of having some capital not being put to work, it's hard to try to like beat some of the current indices right now. It's hard to um, in the face of where it seems like there's a lot of easy money to be made if you just invest in extremely diversified indices, which is fine and good. But it's like I don't know that I would be able to jump out. And sometimes when things coming down fast, it's hard to kind of like make moves. Like if we have another March 2020, some of that happened within the span of a few weeks, going from kind of all-time new highs and then all of a sudden negative 35%. And I was thinking that maybe this could be the big one that I could maybe buy when it hits starting at minus 50%. So I was kind of thinking we haven't gone down enough. So I didn't really jump in too much because I was waiting for more things to be on sale. So that's part of the risk that I took, is like I erred on the side of committing errors of omission where I didn't take an action. So that's something that I have to choose to live with, that um, I kind of was like thinking I'm not getting as good of a deal as I would have wanted to. But I know
uh,
that Warren Buffett has also made that kind of mistake where if something didn't quite hit the price, they've walked away from some deals that I think maybe Buffett has also come to regret a little bit because it wasn't quite the price he wanted to pay.
yeah, but Warren Buffett, even so, he keeps only about 10 or 15% in cash. I mean, it's a lot of money, but it's only in comparison to the overall portfolio. So it's only like 20%. It's never more than that. Um, and you know, having 40% in cash, how does that affect your returns compared to the index, for example, of your portfolio? Are you beating the index with so much cash?
No, I mean, I'm probably not. I haven't like compared it directly because I think it's like not quite a similar strategy. So like I'm trying to be like someone like Seth Klarman, where you can be some years in cash, but if you make investments in buying companies at the price that you want to pay, then you over time might either catch up or at least be on par over time with market indices. But my overall target would be 10 to 15% per year, but I don't think I'm hitting that yet. But it's also it's a little bit hard to kind of fully assess if I'll be right or not, because I'm trying to see if some of the investments I'm doing now, which could be going against me to some extent in the moment, if they will, prove out to be good investments over time. So it's sort of like when you're trying to be a little bit of a contrarian investor, it's not kind of comparing apples to oranges because it's a different expectation and different timeline in general. So
So,
I'm not trying to compare myself too much to the index.
so you're buying individual stocks?
Yeah.
Okay. Okay. And do you diversify, or how much do you commit to any one stock?
Well, I try not to be too much in positions. Like I think between Guy Spear and Monish Pabrai, they try to aim for starting out with 5 to 10% of any given stock that they might be in. So I try to stick to similar guidelines of trying not to exceed too much of between 5 to 10, or maybe at most 15% of my portfolio in any given one stock. And
Okay.
yeah, so I'm trying to really live to the textbook examples that they've set, where they try not to be overly diversified, and they try to be in very concentrated long-term positions, because that's what it seems like has, in their experience, given them some of the more significant returns and enabled them to have multi-bagger returns. So if I feel
Yeah.
like that's one of the ways to do better than average, because I feel like it's fine. The index is okay to get the average amounts of return, but I want to try to see if I can be a above average investor if possible. So I'm trying to go actively against the grain, just because I feel like the way to really like hit a home run rather than base hits is to try to be similar to someone like Guy Spear or Monish Pabrai if possible.
Yeah. So if I ask you, if the index, the S&P 500 index, went down 20% from the recent high, would you consider that a buying opportunity?
Maybe like I'm trying to see if I can overcome some of my biases, because like I said, when we had that March 2020 drop, I'm just thinking back to a little bit of what I've observed from the 2007 to 2009 bear market, the great financial crisis. And I was thinking, this is just the early innings. This is just the beginning of maybe a longer term drawdown. So to me, I thought, why like I'm hesitating to try to really swing hard at the pitch in what might be the first inning, because I'm thinking there's many more innings that I should have better buying opportunities. But then, as you know, we had all that fiscal and monetary stimulus toward the third week of March in 2020. So it kind of prevented that further drawdown. But I just wonder, like, when are we going to have maybe another opportunity of something like a 2007 through 2009, because that took a long time to kind of work through. And of course, that's coming from some systemic risks. And some of that, I'm just thinking, is from what I've observed from the Shiller price to earnings of the S&P 500, which is hovering around the high 30s to sometimes 40 range. I mean, that seems awfully close to what the last all-time high was, when it was 44 in the dot-com bubble. And then based on the Buffett indicator, it just seems like that's also surprisingly fully priced. So even if it's 20% off, it seems like maybe I'm just, too aggressive in wanting or hoping that stocks will go more on sale than that. So I'm not sure if maybe I would nibble, maybe I would like take off a little piece, but I don't want to be, you know, fully in at that point.
Right. Okay. So may I propose that if you consider 20% off the high on the S&P 500 or on any individual stock that you like that you're following, maybe you can sell puts 20% below with a strike, 20% below market. And that way you get some yield on that idle cash that you have. And then if the prices come down, then you can choose to buy or roll forward your puts. It's a yield management opportunity to sell puts because it gives you a low entry point that you're looking for, and it puts some of your cash to work.
Right. That makes sense. And so are you saying like if the market's down 20% to start selling puts for another 20%, almost as if getting like a 40% discount?
No, I'm saying that sell the puts today 20% below the market.
Oh, okay.
The strike price 20% below the market so that you get some yield. Like if you sell a put for 3 months into the future, 20%, or you could even sell 1 year into the future. Sell the December 2022 expiration with a strike price on the S&P 500 of perhaps it's at 465 today. You could do it at 400, 430, for example. That put will have some time value and you could pocket that. And if the S&P goes down to 430, God forbid, you would be able to purchase it at that level while putting your money to work in the meantime.
But when you do that, just wondering, do you have like your buying power is kind of tied up in some of that, right? If you do a leap, and so if you sell a put for a year out from now, you can't use that cash for something else, right? It's sort of like you got paid your premium, and even though you could use that premium, but your overall buying power has been reduced because it's kind of tied up in that contract, right?
That is true. You sort of commit that cash, but it all depends on what happens. If you have a margin account and you have portfolio margin, you could use some of your other investments as margin, and so you have the cash available for any other purchases that you want to do. And remember that you can manage and roll the puts. So if it actually goes below your strike, you can roll it forward for another 12 months, and eventually I think prices can fluctuate wildly in the short term, and I have seen 20-30% moves like we saw last year, for example. But those events are few and far between. I mean, if you look at the last 50 years, I mean, I think 8 times the market went down more than 20% intra-year. And in those 8 times, a few of them only stayed down. It usually recovered during the year. So it's far more common to have a 10% correction. I think it's been like 20 or 25 years of the last 50 years that there has been a 10% correction intra-year. But then at the end of the year, sometimes it doesn't stay down, it goes back up. So, I mean, the economy grows over time. And to have the 500 biggest companies in the world, really, or in the United States, in that index is pretty amazing. And sure, a lot of people say that nowadays, Apple, Google, Facebook, Microsoft, even Tesla account for almost a disproportionate amount of the S&P 500, almost 25% in 5 different companies. So that's a little bit risky, or it's a testament to the wonderful companies that they are, that they command such a big market capitalization. But I think, there's other ways of investing on a equal weight, index rather than the S&P 500. I still prefer the S&P 500 because I think, Apple, commands more value than, for example, Wells Fargo, which has a much less capitalization. So I don't know. Those are my 2 cents.
Yeah, and actually that makes me wonder a little bit about like how some of these have been trending of, if you know about some of the better performers and say the S&P 500, and a lot of them are being held up by like, the top FANG, types. Sometimes I wonder why not just invest in the top 10 or 20 of the S&P 500. And I've actually been curious if there is an ETF dedicated to that or something like that. Like I think I only found an ETF maybe for the top 100 of the S&P, but I think like I'm curious if there's any funds or ETFs that would be so bold as to only invest in the top, say, 20 of the S&P 500, because it seems like why not just invest in the best? Maybe like why bother with the remaining 480 when the index is mostly carried by the top best performers? So I kind of think about that in the back of my mind of like I feel like I'm prone to wanting to be more of a concentrated long-term investor. So I would think like in order to maybe get the best of both worlds, if I had to settle for an index, then I would be curious if there would be one that's dedicated to whichever are in the top 20. And I think maybe there could be some, you could lose a little bit of performance if they need to switch out some positions. Like if, some are in the border between, the 20s and the 30s in their top position. And I'm wondering if, how much frictional costs there might be if the ETF had to sell out all the time of some of the rotating positions. But in general, I feel like even without that, even without exactly investing in an ETF, like that's actually something in the back of my mind I'm kind of thinking about. And maybe I'll look into the top 20 and see which of these do I like the most, because there are some whose values and company trends that I agree with more than others. Like there's some that I don't really want to invest in because I feel like if I wouldn't want to put myself or my loved ones through some of what they're selling, then like maybe I don't want to invest in that kind of company because it's just not aligned with my values as an investor and as a person. So I'm trying to be careful about which kinds of companies that I want to put my money in and see them be in the future, because that's kind of a vote like I've heard or learned, I think, with someone who said in the long term the stock market is a voting machine or something like that. So any stocks that we invest in, we're kind of saying we give you a vote of confidence with our money that we want you to be there in the future. So yeah, I try to also think about that a little bit of which of these companies do I think I can actually believe in. And I feel like knowing what I know now, it's hard for me to go back to an index and invest in hundreds or thousands of companies that I've not even studied and I don't know if I believe in them.
Yeah, no, there are, the S&P 500 index, you can actually buy ETFs on sectors of that index. For example, the healthcare sector or the energy sector, the banking sector. And there is one for technology, and that would concentrate on the top names that we discussed. And there's also the QQQs, which is the Nasdaq Composite Index. That is, I think the top 5 names comprise 40 or 50% of the value of the index. So they are very much more concentrated than the S&P 500 is. So yeah, what you were quoting Warren Buffett, that he said that Graham used to say that in the short term, the stock market is a voting machine.
Oh,
but
okay.
in the long term, it's a weighing machine.
Right. Yep.
In the short term, people they want to run to the exits, and this, the prices come down, and they are, you know, they have irrational exuberance, and the prices go through the roof. But in the longer term, you know, they approximate value. They weigh, you know, they weigh the earnings, and they in the short term, anything can happen. You know, look at the Omicron variant is creating havoc, you know, in the short term. But, you know, who knows what's going to happen? I think it's just going to be like Delta, right? You know, it's a little bit more contagious. It doesn't seem to be as deadly. Let's hope that is true. And but already you see that the Broadway shows have been canceled. The professional sports teams have canceled games. You know, there are restrictions coming up, and that's going to create disruption in the economy. And I don't think that there's going to be another payroll protection loan to businesses this time around. I don't know.
Yeah,
Maybe.
I mean, we'd have to see how much disruption there really ends up being. I mean, like you said, there are a little bit more restrictions, but a lot of things are also proceeding like they used to be, like almost like normal, a lot of things. So I mean, definitely it's a bit of a challenge, and I still think there'll be challenges ongoing, but overall, I'm thinking that, you know, based on what I heard from Jerome Powell, he thinks the economy is much stronger than what it was when there was the initial, you know, shutdowns. But you know, assuming that, and with the amount of inflation we're seeing, they seem like they have to tighten, otherwise they risk inflation going up to an even higher extreme. And I mean, I'm assuming nobody wants to see what we saw in the 1970s again. But then again, that could also maybe lay out the stage for maybe stock buying opportunities like there were in the early 1980s, maybe. So I'm just wondering, like, I'm guessing, you know, if the Fed has almost tripled the amount of monetary stimulus that it had been from even after the great financial crisis, like I think they only added maybe $2 trillion back then to their balance sheet, give or take between 2 and 3 trillion. And now it's at almost $9 trillion. So I'm kind of just thinking, you know, how much is too much for there to be stimulus, and is it really necessary? And kind of like, it feels a little bit like a musical chairs game or a Goldilocks kind of thing, where, you know, you're trying to stimulate the economy just enough, but not too much, where it will then be spoiled. And I feel like like seeing what we're seeing with inflation, it feels like they really have to try to rein in some of the easy monetary policies. Otherwise, you know, everything will just keep going up and up. And I mean, I kind of don't want the US to end up in a high inflationary situation like some other countries are dealing with right now, where, you know, the faith in some of their currencies has been questioned, and they're falling precipitously, like we're seeing in one country right now, like in Turkey. So I feel like that's a really unfortunate situation if there's extreme, you know, things happening there. And I think that's also why, even without the US leading the way, I think that's why, like, the Bank of England is already raising interest rates, and other countries are trying to start tackling the inflation that we're seeing.
Yeah, no, that's a fair point. I think, you know, I agree with you that next year short-term interest rates are going to be higher because of the Fed action, but longer-term interest rates are going to be even higher. So I think there's going to be a steepening of the yield curve, and that's good for banks. But I don't think the higher interest rates are going to affect stock prices, because they're just so low right now, and going up to more normal levels is actually healthy, I think, for the overall economy. But
How much higher do you think interest rates will get?
I think the short term, the Fed funds rate will go from 0 to 0.75. If there are 3 rate hikes, they usually do 25% each time.
Mm-hmm.
They could do 50, but I don't know. But the fact that the tapering of the quantitative easing the purchases. They were buying 130 billion per month, and now they're going to stop that in 3 or 4 months. So that's gonna bring long-term rates maybe from 2% to 4%.
Really? That
Yeah,
high?
yeah.
Wow. Like
So
in the bonds, like in US Treasury bonds, you think?
that's right. And mortgages, the time to fix a long-term 30-year mortgage is now.
Mm-hmm.
You could get, 3% on a mortgage today, and it might be 4% or 5% next year.
Right. Yeah. I mean, it seems like that will more likely cool off the real estate market a little bit. Like, I think we're even starting to see a little bit of some of that now, where, before during the height of the frenzy, it seemed like houses would go up, and in a week they're already sold. And now
Mm.
some houses are starting to stay on the market a little bit longer, as maybe people have either said, I'm not willing to pay such a high price for a house, even with short term, even with interest rates locked in so low. And, maybe enough people have been priced out of the market now that things are kind of starting to turn, that when the mortgage rate is increased, then maybe, even though people will have to pay higher mortgage rates, now they might be able to afford a house more than they did earlier this year or in 2020, I'm guessing.
Yeah, it depends on the affordability index has to do with the income. If your income increases, then you can afford more of a house, and also with the interest rates. If interest rates are higher, you have a higher monthly payment. But it also has to do with the price of the houses. And if housing prices go up too much, then the home builders are going to go into high gear and build more. Sort of providing some balance there. So who knows? I think real estate is going to be a good investment into the future, especially in a high inflation environment.
Yeah, and I mean the other thing I wonder with some of the interest rates is, like, I remember when the Fed started raising interest rates for the first time since the great financial crisis in 2015, and that was like totally fine for the markets. Like, markets were okay with that, but it seemed like in 2018, that was the interest rate hike in late 2018 that finally broke the camel's back. So if we end up on a similar trajectory, that we're hiking interest rates by a quarter, like, a quarter percent every quarter, then I feel like it's a little bit of a calendar game of, could we see the straw that breaks the camel's back by either 2024 or 2025, if we end up pacing at a similar trajectory like a few years ago from 2015 to 2018, if it will be something like that, or if the corporate debt seems too unwieldy. Like, that's the other, I feel like, question mark is, like, I heard from a podcast episode that Chamath Palihapitiya was on in 2019, that he believes that corporate debt will be the next big thing that kind of causes a lot of systemic risk. And, maybe right now during, the tough times, there's a lot of liquidity, and that can be really helpful for businesses to kind of just get by. But liquidity isn't the same as solvency. So at some point, businesses have to actually generate real cash and can't just survive on credit. So I'm kind of just wondering, at what point does the interest rate make the debt untenable? And that's, to me, the kind of like $1 million question right now, is if there's any forecasters or, whichever funds are able to kind of like get ahead of that potential systemic risk, then I could imagine that might be another potential opportunity in the future to try to profit from, or if people get caught in the debt and interest rate trap, then that could be, potential warning sign as well.
Yeah, I think corporate debt levels are reasonable by historic standards, and personal debt, it's not out of the norm. What seems to be getting out of hand is government debt. But in reality, I think the U.S. National debt is really not that bad, because most of the debt, or a big portion of the debt, has been bought by the Federal Reserve, and that's having money in one pocket and owing it to the other pocket. So, I mean, who is to say that tomorrow they're not going to do defeasance of all the debt that's in the balance sheet of the Fed? So you say, okay, all this debt is canceled, and that's the end of it. There's not going to be a need to tax the economy to pay back that debt. So I think that's going to happen in the future, because this is just, trillions. It just defies logic, how much money there is owed.
Mm-hmm. Right. But it seems like, even though some people talk about how high the debt is for the US government, it seems like nobody's actually that worried about it. Like, even though it seems like, oh, it's scary, and you can go to a website where you see like the amount of debt just, every second balloons even higher. But it just feels like it's not somehow, surprisingly, all the like trillions or quadrillions of dollars in debt doesn't really make that much of a difference in the end. I don't know why. I don't know why not more people are worried about that, but it just seems like other things are more of a concern than that.
Yeah. I think, obviously the American economy has a lot of strength, and the investors recognize that. And, the Fed, like I said, has been buying a lot of the debt. And so that has artificially kept interest rates low. And so the cost of money for the government has been very, very small. But going forward, as interest rates get more normal, then it might become a bigger concern. But like I say, there is that buffer that is available at the balance sheet of the Federal Reserve. All those trillions of dollars on U.S. Treasuries, they really don't have to be paid back. I mean, if the Fed makes money, all the money that it makes after their operations in a year, they just make a transfer to the U.S. Treasury. And so, what are we talking about? It's the government's money, right?
Yeah, but I wonder how does that affect or continue to make a difference in assets, like, for everyone else. So it's one thing for, I guess, the government to get some return on their what they've bought in the mortgage-backed securities or US Treasury bonds, but they're probably not getting that much of a return on it, because it's not really, those types of things seem to have relatively low interest rates, right? But I wonder if any of that, or how much of that, has been put into the equity markets to then get either more of a return or not. Like, I feel like I'm not sure, how much that they have a hand directly in the stock market compared to bonds. So it seems like they're more in bonds or things of that type of asset rather than equities.
Who you talking about? The Fed?
Yeah.
The Fed doesn't invest in stocks, does it?
No, not that I know of, but like, I'm trying to understand the linkage of how come all the money that they put in the supply, like all the money in circulation, how that ends up leading to equities also being pumped up so much. Like, it's like we all accept that it seems logical that the more there's been fiscal and monetary stimulus, there's more money out there. But how does that translate when, like, who is putting all the investment into the markets, into the stock market, when the Fed isn't investing in it? It's investing in more so bonds. So how are those two related and connected in the fact that the Fed has mostly stimulated through the bond markets, but somehow a lot of that also ended up in the equity markets? Like, I'm wondering if people are taking out a lot of leverage based on that and maybe investing in the stock market.
It just creates more liquidity, and more liquidity, when the government spends money, it becomes income for some people. And so all the money that the government spends trickles down and becomes earnings for the various sectors of the economy. And that additional economic activity creates liquidity and that liquidity is available to sustain asset prices in all markets.
Right. Yeah. So I guess like and that's getting at like how much liquidity there is, and in that it feels like a form of credit. Like it feels like borrowed money. Like it doesn't feel like it's coming from the fact that the American economy has generated cash just from being productive. I mean, some of it probably will, right? Like sometimes businesses are getting loans so that they can then stimulate their own business activities and then provide jobs to people, and that helps put money into workers. And like I can see how that can help to some extent, but there also seems to be debate about how much is it really helping, how much is it really stimulating business to do the right thing instead of just maybe holding on to it on their own balance sheets. So instead of putting all that credit to work, they're just keeping it in case of a rainy day, and then at some point in the future, maybe paying down that loan essentially in some ways. So it just seems a little bit of like kind of like will we be able to keep up the way that things have been? Like are we going to be okay with a state of where it seems like GDP growth is a little bit lower every year? It's not like how I think it was a long time ago, where the US used to be able to have GDP growth that was more than just 3 to 4% per year. I'm pretty sure it used to be a little bit better, but now it's like we've either accepted or gone into an area where it's okay for the US GDP to be only at 2 to 3% returns per year. And I don't know if that's just the way things are now, if we're permanently in this lower growth state, or if we ever want to be in a higher GDP growth again. And I think that would mean that we would have to be a little bit more austere and not survive on just easy credit as much, but then businesses would actually have to perform, and then just like Darwinian forces at play, it would force out a lot of the weaker hands, and maybe that's not as ideal either. I'm not sure. So it's a little bit of a like an economic puzzle to try to see if we can figure out over time.
Yeah, those are very interesting questions, but who knows what the answer is, right?
Yeah,
I
yeah. I
want.
mean, so I'm assuming from what you've said that how you're preparing for an increasing interest rate environment is to continue buying every month and to just buy and hold.
Yes, continue to buy. I'm writing more calls now than I used to, maybe going up to 20, 25% of my portfolio, out of the money calls, just to get additional income. And that income provides a buffer to the downside on part of the portfolio. But I'm essentially long. I mean, if the market goes up, I make money. If it goes down, I lose money. But the covered call writing provides some cushion there. So I think there's nothing to prepare for, because nobody really can time when a market is going to move, in a material direction. Um, so are you doing anything in particular besides having 40% in cash? Are you going to continue that?
Well, so in the meantime, I think to try to pass the time, somewhat waiting for more buying opportunities, the way that I'm preparing is just by trying to keep learning, like reading more books, listening to podcasts and YouTube videos about trying to just learn from better investors, and see if I gain new insights that I can incorporate into how I'm trying to invest. Because I feel like options is maybe one method, but I'm trying to not focus so much on that. Like I'm trying to just focus on if I can buy any stocks and then just hold on to them, because I'm thinking like it's I'd rather be more of a just buy and hold and not try to do options if I don't have to. Like it makes me sleep better at night, not have to worry about any options trade. So I'd rather just, if there's a stock that's on sale, then I can buy that and I feel good about it. Like if I've done my homework in researching the company, so I borrow books from the library to read about that company, or read about. Like, there's so many biographies of Warren Buffett that I've yet to get to, or reading some of his annual letters that I haven't finished reading them, or even reading like letters from other investors. Like, I want to get to reading the letters of Nick Sleep. So that's also on my reading list. Like, I feel like I'm never ending in how much preparation I can do as an investor in general, because I feel like I can always keep learning, and that's how I'm trying to stay humble. Is even though I've tried to, stick with what I'm guessing is how Buffett, I'm not fully sure, because it's not like he's told me directly this is exactly how I'm investing, but based on just what I've read and observed as a retail investor, I'm just trying to see if I can emulate that example as much as possible. And I'm just seeing Buffett, he's not buying all that much. Like, in one of my recent videos, I talked about how the majority of what he seems to have been doing is buying like a little bit more of Chevron, and also buying back Berkshire Hathaway stock. So maybe, like you mentioned, with banking stocks, maybe benefiting in an increasing interest rate environment, and Berkshire Hathaway is sort of treated as a financial services type company, maybe it's good to just invest in something like Berkshire. And I'm trying to see if I would want to average up in there, because like, part of me is also like, I'd rather average down, not average up, but I might have to get over that a little bit to, be okay with averaging up into a position. Like, if I buy more Berkshire, and even though to me it's a little bit like, it doesn't make me feel good to buy into something that just feels like it's going to keep going up a little bit in the short term, because when and if the shoe drops, I just feel like a dum dum if I bought into something. Like, let's say I bought into something at $300, and then now it's at $250. Like, I want to hit myself with the shoe, because I'm like, I could have just waited until it went down to 250 and then bought, then not bought at 300. But like you said, you can't time it. So, like, to me, my alternative is either I buy at a higher price and I live with it, or I don't take the action and then live with the consequences if it goes from 300 to 350, or I wait, or I hope that I will have a buying opportunity at 250, let's say. And I'm just making up those examples. It doesn't mean that I'm not saying that those are necessarily, what I've come to the conclusion of, but yeah, it's a hard
yes.
balance to me.
Yeah. So what is it about investing that gives you passion for this subject?
Well, it's that it's like, the way that I've learned from Monish Pabrai is that it's sort of like a hunt or a game, where Warren Buffett was always trying to look for Exarban tickets, the historical Nebraska racetrack, where Exarban is Nebraska spelled backwards. And I learned that Warren Buffett would always go to that as a child and look for the winning tickets that people had thrown aside, and then he would cash them in through his aunt. And for him, it was the hunt. It was the game of it, of like trying to see if you could, kind of find some winning tickets, I guess. So in a way, like, what makes me feel passionate is that, out of all of the companies, you're kind of looking for treasure among them, of what either, hidden treasure or maybe more obvious treasure is right there in front of investors, and we can either choose to see if we want to invest in them or not. And I think that's what gives me passion for it, is that it's one of the things that I feel like is a virtuous kind of thing to do, is invest in the companies you believe in, and that you want to see them be continuing to thrive in the world and to help humanity to go in the right direction in life. So I think that's what gives me passion for it. And I'm curious what gives you passion about investing.
Well, I think that, investing is a way for the middle class, the people that are living paycheck to paycheck, to actually get financial independence. A lot of people used to say that education is a pathway to financial success, and I agree with that. But also investing, and that's why my financial education channel, I think, achieves both, because by investing as little as $100 a month in the index, in this S&P 500 index, that can really make a difference in people's lives, over the years. And there will come a time when, your investment income is going to be higher than your wages in any particular year. And at that point, you could be financially independent. And if you continue to work for a few more years, that those investments will continue to compound and provide real financial security for many families. I think that's what drives me to inform more people and to try to put out the word out there for people to learn about investing and to invest, because a lot of people are scared about the stock market and they invest in bonds and they miss out, because $170 invested every month is $2,000 a year. And if you invest that over 50 years, that's $100,000. But if you invested in bonds, it's only going to be like $400,000 at the end of 50 years. Whereas if you put it in the market at 10%, assuming that's $3 million, I mean, it's not even close. It's a big difference.
Right.
I see a lot of people that invest in 401ks and they put it in bonds and they put it in a money market in a 401k. Imagine that. That shows a lack of understanding and an opportunity for education for all those people to learn that when you're investing for your retirement, what do you care if there's short-term volatility? You don't need to have a balanced portfolio to manage short-term volatility, because it robs your portfolio the ability to compound at the highest rate possible over time. So I don't know. I think we've covered a couple of things in this video. Do you have any closing remarks?
Well, Guillermo, it was awesome to speak with you about all of these subjects, and I agree with you. I think more people should be in equities rather than bonds, because with how things have been trending over the last couple of decades, it feels like it's not rewarding to be invested in bonds too much. And part of me though wonders, the mainstream advice with especially retirees, they say, oh, you should be more in bonds, they try to encourage older generations to be more in bonds, but it feels like a little bit of lopsided advice, just because the reality is, unfortunately, bonds don't seem to return enough. So do you think that for especially retirees in their 60s and 70s, do you think that they should be more weighted towards stocks?
I think so. I think obviously somebody retiring at 60 is going to live at least 20 or 30 years more. And over that time frame, if you have a portion of the portfolio still growing and compounding, it's helpful. Obviously, if somebody at 60 or 70 is retiring and they're going to need, a steady stream of income, so it's okay for them to sell a portion of their stocks and put it in some sort of a fixed income ladder with the maturities as they come. But I think it shouldn't be 100% of their portfolio. I think they should still have a portion growing for them over the next 20 or 30 years of their retirement.
Yeah, so it's a kind of always a delicate balancing act to try to make the best financial decisions and try to achieve financial independence. And I agree with you with that. I'm glad you're also promoting education toward that. And I commend you for also trying to help everyday people to try to get toward their dreams of financial security and independence and all of those ideal goals, because then that frees up a lot of time, and then we get to spend more time with our families or with the things that we would like to be doing, instead of what maybe could be the alternative of just working all the time and you don't maybe see the rewards of that right away. And like you said, generating returns from investments can be more powerful, and you can generate more maybe than your wages over time. So I think that's a great lesson, and I appreciate that you put out that message out there too. And I think that's a great example to learn from you, that it can be done, from what you've told me about some of your background of how you've worked, and now you also get income from your investments, and that's wonderful.
Yes, yes. And I commend you for your channel. I think I have watched a lot of your videos, and I think you have a very, very spot on analysis, and you have very, very good material. So keep going. I think you're doing a wonderful service.
Thank you, Guillermo. Well, it's been awesome talking with you, and I hope you have a great weekend.
You too.